please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Hi, good afternoon. You're watching Midcap Radar, and it's turning out to be a bit of a painful afternoon, actually. So look at the market. We're down at the lowest point of the day now, pretty much on the indices. So the Nifty is down about 80-odd points, and the Sensex is seeing a cut of almost 250 points as we speak. A lot of this weakness is also being reflected in the Asian markets, in the European markets. So at least some of those markets in Europe are seeing a cut of about 1% as we speak. Asia, too, is reeling under severe pressure, and as we speak, the rupee, look at that, nearing that 72 rupees to the dollar, just about 6 odd paise away. And for our market, what's not looking good? So individual names, look at Reliance. That has seen a very, very sharp fall actually in just the last few minutes alone. HDFC and HDFC Bank, the twins, continuing to exert pressure on the market from the get-go. Kotak Mahindra Bank, that's another big one that's taking away a lot of points from the Nifty. In fact, if you look at the contribution chart, you'll see that these are actually the biggest culprits of the day. And even the Midcap index, it just continues to extend actually cuts from yesterday.
Yes, absolutely. So the Midcap index is underperforming, and all the stocks that you name, right, which you can see on your right-hand side, a Reliance, an HDFC Limited, a Bajaj Finance, Finserv, these stocks were actually trading at record levels just last week. So in a span of about a few days, the market confidence seems to have been shaking, and you can deal with the rupee depreciation if it's on a gradual basis. Yeah. But in a week, just exactly the same time last week, the rupee was what? Below 70, and now we're talking about a level of close to 72 against the dollar. So it's the velocity of the fall has taken everyone by surprise, and it's also caused a bit of anxiety and shaken the market confidence. But the US-India Business Council's India Idea Summit is currently underway in Mumbai. Let's cut across to Thomas J. Donohue, the President and CEO of the US Chamber of Commerce, speaking at the summit.
Early time visit to the United States to continue the extraordinary relationship that we have had for a long time, and we're hopeful that when he's there that you'll join us. We're proud to have him as a major player in today's event. We'll also be joined by the Commerce Minister later this evening. We're also proud to have all of our distinguished guests here today for what promises to be a unique and special gathering of the USIBC. I will say again, the first time it has ever been hosted in India. That's symbolic for a couple of reasons. First, that the U.S. business community recognizes the increased importance of our relationship with India, and we want to be here in person to strengthen the bonds of commerce that are key to our future.
All right, we'll get cut back actually to that as and when there's more talk on, trade and trade fears, as well as the kind of negotiations that are ongoing with different countries. But for now, let's get back to our market and focus on what's happening there. Ashwini Gujral joins in as well. Ashwini, hi, good afternoon. Cuts getting a little bit more exaggerated now. What's your take on the index and individual stocks?
See, the index remains in a fairly strong downtrend. Now, whether you want to get in here or maybe wait for a bit of a rally, that remains a personal choice, but don't try to buy, because as several people have discovered that the bounces are very minor and the sell-off is ferocious. So if you want to buy, maybe buy the dollar rupee. So, and bond yields are continue to move forward. So this is a market which is expanding on the downside, and you're much more likely to see lower levels than your hardly 20-30 point bounces. So each time you get that, you should use that to sell. Now individual stocks, Bajaj Finance is a sell with a stop of 27.25, target of 26.50. Kotak Mahindra is a sell with a stop of 12.55, target of 12.10. And Kaplan Point is a buy with a stop of 475, target of 490.
Ashwini, your thoughts on the currency? How much lower does it head according to you, based on the charts?
See, it's fresh lows. Yeah. plus the situation, macro news is with the currency. So right now it's basically, blue sky territory, but from 69.50 to about 71.50, the technical targets are more or less met. Now, where it can stop, maybe 72.50, 7300, but the pace is very ferocious, so that basically means it's in a strong downtrend.
Okay. Just some more thoughts on large caps. Reliance Industries. That stock too has fallen quite a bit in the last few days. Where would you stand on that, as well as on the HDFC twins? They too are under significant pressure today.
Well, it went up also quite a bit, from 950 to almost 1350. You can easily give back at least 35% of 35% of those gains. The problem is that people forget the kind of rally that was there, and now that macros are against you, profits will be taken off the table, and this correction is a correction on a larger time frame. So far, last 2-3 months, we've seen 2-day corrections. But my sense is that you will give back 300-400 points on the Nifty before it's over. And yes, macros need to turn, rupee needs to stabilize, maybe crude needs to decline. Before that happens, I think we're in the midst of a storm and it has some way to go.
Okay. Thank you, Ashwini, for that. Ashwini, of course, in the morning as well had said that, prime yourself for a bigger correction, especially in the second half of the trading session. But let's cut across once again back to the US-India Business Council's India Idea Summit, currently underway.
The potential is. Achieving that full potential is what brings us here today. The India Ideas Summit is all about, well, ideas. Ideas for the future and ideas for growing our friendship and our partnership into a game-changing global force that has the potential to be something really special. Thanks in part to many of the leaders in this room, that effort is gaining momentum in all the right places. There is general agreement across the U.S. government that our relationship with India is a significant priority. We saw evidence of this in July when the Chamber hosted some of the senior-most officials from the Trump administration to discuss their vision of the Indo-Pacific. We heard from Secretary Mike Pompeo and Secretary of Commerce Wilbur Ross and Secretary of Energy Rick Perry, all in the one place where people come to meet, and that's the Hall of Flags at the U.S. Chamber building right across from the White House. The takeaway from their presentation was crystal clear. India is at the center of this administration's vision for seizing opportunities in Asia and truly worldwide. We'll see further confirmation of this tomorrow when Secretary Pompeo and Secretary of Defense Jim Mattis will be in New Delhi for the long-awaited 2+2 gathering. That dialogue is aimed at strengthening America's defense partnership with India. Just one comment about defense. You can't do defense without economic strength, and the 2+2 will set the groundwork for some things that will not only improve our defense postures, but is clearly going to lead us towards that $500 billion.
Gone in the mid-cap index. The Nifty and the Sensex down close to about 0.8%. Gautam Sinha Roy of Motilal Oswal AMC joins in now. Gautam, there is a strain in emerging market currencies as well as in economies. Earlier today, we learned how South African economy has slumped into a recession. We know the issues with respect to Turkey, etc. Closer home, Indian macros as well. The picture is not looking good. The rupee is approaching 72. Bond yields are approaching 8.1%. Is this a start of a very big correction, something which the markets have not seen, at least for the last so many months?
Well, you indeed present a pretty dismal picture. But yeah, things are turning. Things are turning for sure, and it coincides with the the true end of QE from the developed markets, right? The cumulative balance sheets of all the developed markets is now finally started to contract after having only expanded for 10 years since Lehman Brothers, right? So that's a very monumental event. We should not discount the importance of such events. This is a historic moment for global markets from a, if not anything else, from a sheer flow perspective, right? That carry trade or whatever you call it, which was led by money flowing out from the US into emerging markets, into many other asset classes, has caused to reverse now, and probably we are seeing the first impact of that happening across the world. Obviously, countries, economies which were most vulnerable to such an event happening are suffering the most and suffering first. So the key question to ask is, specifically for India or for any other particular country, is that whether you are vulnerable to such an event or not. Now, how do you become vulnerable? If you look at our current account deficit, obviously we have some challenges there. A challenge which gets exacerbated by the fact that crude prices are only going up, right? So we have challenge on the current account front. We have benefited a lot from FPI flows, both debt and equity, over the last 3-4 years, which has held the currency stronger than it would have normally been on REER basis. So I think a lot of that strength is now being given away, and we are seeing the currency finding its natural level. Going forward, what will matter is how strong the balance sheet of this country is. We have maybe around $400 billion of reserves, which is among the highest in the world. So that will come in handy in signaling to the market, if not anything else, that we are going to be able to defend the currency. Other thing which will be important is, do we have competitive export industries, which we believe we have. In services, IT is the leader in the world. We have pharma, we have autocoms. So we have industries which will start naturally benefiting from a weaker currency, and which will actually aid the export front. And if you see, the export front has done nothing for quite a few years, and that's also been, that problem has been worsened by the currency being strong. So there are negatives, there are positives to it. I don't think India is a vulnerable country at all. And if the market, especially the equity markets in India, correct, it will become again attractive for foreign investors, simply because we are so decoupled from all the problems happening in the world, be it the trade wars, be it the currency route. So it will stand out as a beacon of hope among emerging markets, and it will attract foreign flows. So let this route play its own course. Don't get worried about it. It was coming for a long time. It was due. It is happening now. We'll live through it, and finally we'll have a opportunity to get back into the markets after the correction. And from investors' perspective, that's all what matters, right?
Hey, hi Gautam, good afternoon. I like your optimism that we live through it. Well, one certainly hopes so. But let's talk about your fund, your Focus 35 now, the multi-cap 35. I was just going through your holdings. I think the bulk of it, what, 94-95% is just in the top 10 stocks, of which the bulk is the large caps. Is that the advice also for retail investors? Therefore, is that large caps is the place to be and still stay away from the mid-cap end?
Yes, although the causality, like the way you put it, is not that. It's not because the fund is positioned like that. But generally speaking, I would advise investors today to come in with a degree of caution to the markets, right? Two things matter there, mid-cap valuations and particular sector valuation. Like today, everybody is crying hoarse about FMCG being expensive. Well, FMCG has been expensive for the last 1 year. I don't know what happened today that people have woken up and realized that. But the fact remains that there are pockets of the market which are very, very expensive, +2 standard deviations above long-term normal. So stay away from that. Mid-caps, small caps, bulk of that is that category. FMCG is that category. So it's a market where, firstly, you should avoid buying expensive stuff, and secondly, if you're coming into market today, have a longer horizon, have at least a 3-year, 5-year horizon for which you're coming. Otherwise, a PE correction could eat away a substantial portion of your returns. So it's a market for the patient investor, and it's a market for the risk-conscious investor, right? So these two things are important to remember.
Okay. So, Gautam, the extent of APE contraction, according to you, which is likely for the Indian markets, as well as the extent of downside or correction?
See, markets have not really begun to correct, in my opinion, especially the broader market, the large cap index. And that's also driven to a large extent by the enormous amount of domestic liquidity which has supported the market. Now, part of that domestic liquidity, let's say the SIP book and all, PF money, is structural. So I don't see that market is going to correct majorly. It could be a time correction. There could be a 10% kind of correction. No one knows that. I wouldn't try to second guess that, and especially the timing part of it. But the important thing to remember is that valuations, the rich valuations, make it slightly risky to come into markets aggressively today. Good part is, at least at the index level, we are seeing earnings growth coming back into the picture after a very long time. And it looks like this year we should clock close to 20% earnings growth at the index level, the Nifty level, right? Even maybe the top 100 stocks level. So that is supportive for valuations, and that should, other than liquidity, the earnings growth is another aspect which will make sure that the correction is not very deep or severe.
Gautam, the big variable also, apart from all of this global stuff, remains elections in our own market. How are investors looking to step around this, or step around rather the headwinds that this creates?
So actually, if you ask me, the biggest risk to market from a one-year perspective remains the elections, because we have had political certainty for a while. If that is challenged because of the election results, there will be, and the markets are richly valued, there will be there will be some negativity built around that. So that's what makes me cautious about the elections. But the thing to remember about elections are always risky at the time of the event, but over a long period of time, elections don't really matter, right? The corrections, whatever happens around the election time, it essentially gets bought into, and the markets recover the natural course. So it's an event risk which could present an opportunity of a correction to the market, is the way I would look at it.
Okay, Gautam. Thank you very much for your time this afternoon and speaking to CNBC-TV18. So that is an important domestic voice. Let's also get in a global voice. We spoke to Nick Parsons of Thomas Lloyd earlier, and he says the Indian equity markets is more vulnerable than the currency market. Listen in.
India seems to be a victim of its own liquidity. When you have an almost indiscriminate sell-off in an asset class, then investors sell what they can. I think the Indian equity market is perhaps a little bit more vulnerable than the Indian currency is. It's not the case that we've got a flight of foreign capital. It's not the case that investors are unsettled by India's macroeconomic performance. We've got GDP growth of over 8%. We've got inflation which is around 5%. We've got huge FDI inflows into the country. It's not a particular cause of concern. Rather, it is this indiscriminate selling of emerging markets, and India has been caught up in that. And I think this is going to offer some wonderful entry opportunities here. Well, we've been to 71.67 now. We're very close to being at or near a turning point. I think once we see a change in perceptions on US interest rates, then I think the pressure is going to be off. And then I think we'll start to look a little bit more selectively at the individual currencies. And when the market does start to look more selectively, it surely will ask itself, why on earth was India the worst performing currency in Asia in the third quarter of 2018? Because that simply is not warranted by the economic fundamentals.
All right, that's a global opinion on the markets. By the way, keep your eye on our own Indian markets. Now it's a deep shade of red. The Nifty is down more than about 100 points. The Sensex is down close to about 300 points. The sell-off is getting exacerbated even in the mid-cap space. Large caps, there seems to be no bottom to these large caps. So HUL has lost another 2.5%. Bajaj Finance has seen a crunching blow. That's lost about 2.5%. Reliance Industries, weaker in trade, now 12.10 on that. ITC, a stock which is holding up with gains of close to about 1.5% earlier in the morning. Now ITC is also close to dipping into the red. Weakness seen in other large caps like Bharti, M&M, Kotak Mahindra Bank, as well as Titan. So things are looking bleak for the Indian markets. We'll slip into a very short break. We'll come back with more on individual stocks. Stay tuned.
11,400 now on the Nifty and a 340-point cut on the Sensex as we speak. Amongst the casualties today and over the last few days have been FMCG stocks, HUL, Nestle, Britannia, Jubilant Food, Godrej Consumer, you name them, they've all been under pressure. So Mangalam is here to tell us what's going on. Mangalam.
People are cognizant of the fact that the crude is higher, rupee is also weakening. So people are perhaps protecting the money, they're taking profits wherever they are finding it, and they found it in FMCG space. So the likes of Godrej Consumer, Jubilant Food, Britannia, HUL, all the stocks that you spoke about, down anywhere between 7 to 9% in this month itself. Just to look at HUL, it's down about 9% in the last 3 sessions, and that's the biggest cut that we've seen in HUL over a 3-day period since July 2013. And we've also had 2 brokerage notes in a span of 3 days, back calculating the forward valuations and implying future growth. The likes of CLSA, they've written consumer stocks in India have always traded at a premium PE, but however the extent of PE expansion is what has perplexed even the most optimistic of all bulls. But tell you what, a lot of the brokerages themselves went ahead and expanded the PE multiples of these FMCG stocks. We got CS note today. Credit Suisse wrote that competitive intensity is back up in the FMCG space. HUL's 2 variants, Surf Excel, had a large white space as P&G's competition wasn't as intense, and now they're coming back in the game. The price difference between HUL's offerings and P&G's offering are not much, and HUL is also trading at a 10-year valuation high. All these things are coming to the fore right now, but these are not things that we do not know. HUL, after the first quarter management call itself, said that, competitive intensity is likely to go higher. Yes, it was trading at 53 times 3 days ago. Today, it's trading at 48 times FY20 earnings.
Okay, Mangalam, thank you very much for that. Let's get you some more market opinion as well. We had spoken to Tushar Pradhan of HSBC Global AMC earlier today, who said that the Indian IT sector is gaining traction from a depreciating rupee, and he sees pockets of opportunity in metals and NBFCs.
Clearly, the IT sector is getting a pretty strong tailwind from the weakness in the rupee. And on top of that, we have seen, pretty positive sentiments coming out of the US, which is the largest client area for Indian IT. I think a combination of all that and probably the headwinds that we saw of a very strong rupee in the last 2 years coming off, I think all of that is starting to show up in the numbers. We are also seeing very strong, I would think, body language from most of the IT majors. And this time the IT strength is actually running across not only the larger IT companies, but going down into the mid and the smaller companies as well. Indian metal manufacturers or companies in the material sector actually also do benefit from a lower rupee, because most of these global metals are indexed to the LME prices, which are dollar denominated. And as a result, their revenues actually do start to go up. So as long as you have your debt under control and your costs under control locally, you'll start to actually make a lot better margins this year as well. If one tries to be a little more granular, you will find that there is plenty of opportunities even now. I think with the public sector banking sector in such a difficult space, I think lack of credit is really the bigger concern. And as a result, I think these NBFCs are really filling the gap.